Hi there, class. This is video number 8. Is the company worthy? The agenda here is to talk about what it takes to have a company that is attractive to investors. We call this examining whether or not the company is worthy of investment. In one of our early videos, I shared a quote from Paul Graham, who said, "The first step to capturing investment is to build something worth investing in." In this section, I'll touch on issues that relate to the question, is the company worthy? VCs are looking for companies that make success seem inevitable. What signs exist to show that your company is one of them? It's possible that venture capital might not be a match for your company. So this is kind of step one. VC is only one of many ways to finance a company and is most appropriate for a particular kind of company. There are a lot of businesses that are otherwise awesome, which aren't a fit for venture capital. They just don't fit the model that matches how VCs make money. They may not grow fast enough or have the potential to grow large enough, but they may be strong, profitable companies for years. One of my favorite venture capital alternatives, or alternatives to traditional venture capital, is Indie VC, which was founded by Bryce Roberts. Bryce is a BYU grad, right? We won't hold that against him. I really love his creative approach to finance, especially within the vision of helping founders find a way to do great things. What's the takeaway? Be sure you know VC is right for you before you go after it. For the case analysis report assignment, I introduced you to the 4 strategic components of risk framework. The first 2 components of risk fit squarely in a discussion of whether or not the company is worthy. The first of those is product risk. The key question you have to ask is the product developed and ready for sale? Historically, there have been times when founders successfully sought funding for products that were no more than ideas, concepts, or maybe blueprints. Who knows if those halcyon days will ever return? I honestly hope they don't. Companies built around products that are already ready for sale are less risky than those still trying to figure out what they're going to sell. Software startups often have continuously developing products, which sometimes puts them in the position of raising money while still trying to figure out the end product. They have a product developed, product in quotes, but not one that is ready for anyone to buy yet. The important thing to understand is that this scenario, right, an underdeveloped product is simply higher risk. The lowest risk on the spectrum would be fully developed products with proven product development processes set to fill your sales channels as your current products decline in their life cycle. When it comes to product risk, high risk equals NewCo with an unknown product, while ultra low risk is Apple with years of new products already under development and in their product pipeline. The second strategic component of risk that applies here is market risk. In economic terms, market risk is demand risk and competitive risk. Do people want what you're selling? Do they prefer competitive products? How can you tell? One way is to ask, have you ever sold one? A magic moment in the life of a company is when they close their first sale. That first dollar someone hands over because they find value in the product is a huge milestone. Low risk on market means that the market's established and you're selling hand over fist. You're making sales and you don't even know why. As an early company, this is evidence that early adopters are making sacrifices to get their hands on your product, even with all of its flaws that you've touched on kind of a major nerve of demand. Super high risk is you've never sold one yet. You don't know for sure if you can. Next, you want to know that you have a large and growing market for your product. This is often described as your total addressable market, or TAM. So where do founders go wrong in describing the TAM? Well, they often overestimate the size of their market. Venture capitalists sometimes are only interested if the TAM is huge. If they need the possibility that your company can exit at $1 billion or more and reckon that you can capture maybe 5% of the market, then that means you need to start with a $20 billion TAM. So big is awesome, but your target needs to be realistic too. Whatever you do, don't start your description of the market by citing the 3.6 billion internet users in the world or 126 million US households. Those data points might be relevant if you're Procter & Gamble, but as a startup, you've got to show an understanding of the market in terms that are genuinely relevant to your business. This puts startup founders in a tricky spot. You want a big market, but starting out tackling a $20 billion established market is incredibly hard. You can't capture it all at once. So we segment it into smaller chunks called SAM and SOM. I'll explain these in just a moment. For now, just realize that your best bet is to nail a small market that you can really serve well and hopefully generate early revenues from, with an eye to expanding into nearby markets as you gain strength. Prominent VC Peter Thiel says, the most successful companies dominate a specific niche and then scale to adjacent markets. TAM, SAM, SOM is an approach to grappling with and communicating your understanding of that principle to investors. It trims the fat out of your market estimates and shows how much market share you expect to capture. TAM, as I mentioned, is the total addressable market. This is the total market you could capture at maximum scale. It's unlikely that you will ever own all the TAM. SAM is the segmented addressable market. This is the local market segment available to you. And SOM, this is the share of market. This is how much you can capture immediately or in the short term. If you have a marketing background like me, you might see some similarities to the segment target positioning strategy that's common in marketing. But investors are going to be more familiar with TAM, SAM, and SOM. This approach is common enough that it's included in Sequoia Capital's published pitch deck template, and it really gives you a framework for articulating market size in a way that investors understand. Now, do you remember this slide from one of our earlier videos? Here we asked the question, what is technology? The answer was that technology is an idea plus execution. I hope you're picking up on the theme that a great idea is not where the value is in a startup. If ideas were really scarce, then it certainly would be. But it turns out that great ideas are actually really common. Even if you can't think of one right now, it's easy to find one. But what is super rare, what creates real world changing value, is the ability to execute on a great idea. To underscore this, I'll use a quote from Michael Dell. Michael Dell is the founder of Dell Computers, and he says, ideas are commodities. The execution of them isn't. So what does this mean? It means that for your company, you need to demonstrate execution on top of a great idea. That covers the first section of company worthiness. Now we'll talk projections. The next item to know is that all projections are created equal. Founders make projections about the future of their companies. They have to. Vision for the future is what inspires the startup ecosystem. Founders articulate these projections and issue pro forma and forward-looking statements, and they're found in pitch decks, business plans, board meetings, and more. They typically project growth in revenues, customers, users, or market share. There's one thing that all of these projections have in common. Charted on a compass, they all point northeast. That is, they all point generally up and to the right. Everyone projects growth. Nobody projects contraction and loss. Investors know and expect this. Next is that all these projections are lies. Equally universal as all projections for the future pointing to perpetual growth is the fact that they're all lies. That is not to say that all founders are liars or that the exercise of building projections is foolish. Projections are rarely intentionally misleading. It's just to admit that human beings are not generally great at predicting the future. Models contain flaws. The unexpected and unaccounted for arrives. Founders don't possess a crystal ball about the future any more than investors do. Bo Yagamai, head of New York Business and Finance Group for Cooley LLP, which is a well-known law firm that services VCs, wrote in an article called "The 7 Elements Investors Look For in Your Funding Pitch," and I quote, "Unless you are a later stage company, the numbers in your projections typically don't matter. Nonetheless, putting together a set of thoughtful projections on both the revenue and cost sides enhances your credibility with potential investors." End of quote. Many companies ultimately do grow, but none of them hit their projections exactly on target. Investors understand that they're in the business of probabilities, not certainties. So along those lines, don't say that your projections are conservative. Even though they know that your projections inevitably point to growth and that the likelihood of you achieving them exactly as projected is zero. Experienced investors will still be interested in your projections and the assumptions behind them, but they will also automatically discount them. Many entrepreneurs say some variation of, "These projections are conservative." They feel that showing their restraint will somehow win investors to their cause and convince them that they're fiscally disciplined, or maybe give them comfort with the fact that they've led with the worst case scenario and the true future is bound to be more favorable than what they're showing. But this usually backfires because the investor is now discounting your projections that you've already self-discounted. So you're lucky to get credit for any growth at all. Guy Kawasaki writes about presenting financial projections to investors, and he says, quote, "Don't call your projections conservative. We refer to this as entrepreneur lie number 1. Investors want to see a bold plan that is well thought out and realistic if everything goes well. They don't want to see a delusional plan. Your job is to show them that you have tapped a team with the experience and insight to justify your bold optimism," close quote. Build the smartest projections you can. Aim not for optimism nor pessimism, but realism. Then understand that the deal still needs to work after your investor applies a heavy discount when they do their own analysis. Next, you need a monopoly and a moat. What's your unfair advantage? What makes you able to beat out the competition? Your task is to articulate reasons that your company will not be copied, overrun by followers, outcompeted, etc. Is your business defensible? Do you have any IP protections like patents, trademarks, etc. that give you some legal ability to defend your position? These are seldom deal winners, patents and trademarks and whatnot, because VCs know that the burden to defend patents is on the patent holder, and your ability to defend depends not just on having a patent, but on having the money to pursue legal action, which you probably don't if you're fundraising. Even still, better to have them than not. Better moats than trademarks and patents are unique industry knowledge or position and natural barriers to entry for competitors. Whatever your situation when raising capital, you need to communicate how you're going to beat the competition and protect what you are building. Next up, we'll discuss the ideas of product market fit and your magic ratio. So in 2007, Mark Andreessen, one of the founders of Andreessen Horowitz, said the only thing that matters is getting to product market fit. So what the heck is that? Well, volumes have been written since about what that is, but the gist of them all is that you need customer validation of your product. Customers need to really want it. Startups sometimes raise money pre-product, sometimes raise money with only a trickle of revenue, so they haven't really proven that there's a market of people who are over the moon crazy and happy to pay for the product. Paul Ahlstrom, Managing Director of Alta Ventures, which is located here in Lehigh, and author of Nail It Then Scale It, The Entrepreneur's Guide to Creating and Managing Breakthrough Innovation, says, entrepreneurs innovate, customers validate. In other words, you can't depend on your customers to come up with the answer, but without customers telling you your product or service is solving a problem for them, everything else about your business is really suspect. Ultimately, founders, investors, and all other stakeholders get paid by the customer. So you've got to know a couple of things about them, like if you have any, and if they're excited to pay you for what you're making. It can be tough for startups to get a handle on their data. Here's an excerpt from the SaaStr podcast where Dave Kellogg, CEO of Host Analytics, talks about what he thinks the most important metric is for a company to measure.
So I want to discuss metrics and what you believe to be the truly defining metrics that can have a transformational impact on companies compared to the plethora that are kind of out there and constantly discussed in public.
Yeah, it's easy to drown in SaaS metrics because there's so many different things to measure. And I developed a passion for this subject when I joined Host Analytics because a big reason is if you want to raise money, the venture capitalists are all obviously very into SaaS metrics. So this is an area I'm passionate about and have spent a lot of time in. And if you only gave me one, and I like to be reductionist, if you only got one metric, what would it be? And to me, I would actually pick LTV to CAC, i.e. the lifetime value of a customer divided by the cost of acquiring a customer. Because with just that one metric alone, you can figure out if the economics of a business are going to work, right? You may have a great LTV to CAC and not be growing, but maybe that's because you don't have enough cash and you can't afford to go acquire more customers, right? But if fundamentally, when you think about LTV and CAC is what you pay to get something, and LTV is what it's worth. And to me, fundamentally, if you had just one thing, I want to know how much am I paying to get a new customer, and then once I get them, how much are they worth to me over their lifetime? And just knowing that ratio of those two numbers can tell you an enormous amount about a SaaS business.
The magic ratio, or lifetime customer value divided by customer acquisition cost, is an excellent way to nail a couple of the critical metrics. And you get to your magic ratio with LTV divided by your customer acquisition cost. This is a good way to visualize the magic ratio. If you are unit profitable on the sale of every product the moment it goes out the door, you don't need this level of analysis. If your customers typically purchase only once, then this also doesn't apply. But often companies depend on a relationship with their customer, which includes multiple purchases over time. In B2B companies, this is particularly common. You want contracted revenue that repeats. This is the idea behind the software as a service model. With these longer relationships, that means you might not be profitable on the initial transaction. You start out actually in the hole. But if you understand where you eventually end up, that will tell you if you eventually become profitable and by how much. So we start with the customer acquisition cost, or CAC. This is how much you need to spend in advertising, marketing, or other efforts to acquire one new customer. Since we haven't made any money yet, this is an expense we're going into the red for. Next, we look at the payback period. The payback period is how long the customer needs to pay you before you've recovered your CAC. At this point, you're back to break even on your cost of customer acquisition. VCs, especially in tech, are often looking to see that this payback period is 1 year or less. Next, we have the lifetime value, or LTV, of a customer. This is the average revenue a customer will generate over their entire relationship with your company. And that includes the initial purchase and all subsequent repeat purchases. LTV equals all-time revenue per customer. When we talk about growing a company, it's common to look at contribution margin. Contribution margin equals price minus cost. To make a profit, you must not pay more to acquire customers than they will ultimately pay you. LTV gives you the flexibility to see not just what you can spend to make one sale, but what you can spend to acquire the customer and still turn an eventual profit. LTV is the present value of all future profits that the customer will generate. At some point, you're going to lose customers. We call that churn. These are the customers that don't renew. Ultimately, you'll have an average lifespan of your customer. Once they churn out, they no longer contribute to LTV. So, CAC is equal to your total customer acquisition spend divided by the total number of new customers you brought in. LTV is equal to your gross margin per customer multiplied by the total number of customers minus churn. And you get your magic ratio with LTV divided by CAC. Ideally, you want this ratio to be 3-to-1 or higher. Next, profits cover a multitude of sins. If your business is profitable, other warts matter much less. Profits might be elusive in your startup, but don't fall for the idea that they don't matter. They are always the ultimate goal because they're the only long-term way for you to generate returns for shareholders. Profitability delivers an assumption of competence around a market. We may not be able to infer how big the market is, but we know for sure that there is one, as well as competence that you understand your unit economics, fiscal discipline, and priorities. Profits lessen the risk that the business will fail and indicate the ability to generate sustainable returns. Criticisms of profitability from investors will likely arise around whether the company is focused enough on growth. High growth typically means high burn, which can suppress erstwhile profitable companies from showing more black ink on their financial statements. Sometimes growth is a justifiable trade-off for profits. Whichever focus you choose, you ought to be clear about which trade-offs you're making and why. Communicating this to investors may bring you into or out of alignment with what they're looking for. You want there to be alignment around your strategy here before you take the investment. At the end of the day, VCs have many companies that they will invest in. Founders only have one. Remember that profits are the cheapest money you will ever raise. These dollars have the fewest strings attached, the least amount of precious equity given up, and the most happy customers as a result. And the terms are the best you can get. As a founder, a profitable business is simply a better business. Which leads me to one of the metrics you can use when you have profits. Every investment has some waste, some inefficiency, some amount of dollars that don't directly fuel growth in the company. Painfully obvious examples are things like retiring old debts or maybe cleaning up problems from previous investors. Nobody likes seeing their new investment used just to clean up past sins. But even without things like this, there are little drags on efficiency. Investors developed the term return on invested capital, or ROIC, to measure how much return their particular investment is generating. The formula for ROIC is net income minus dividends divided by debt plus equity. If a company has a strong return on invested capital, then it's demonstrating efficient use of investor capital to fuel growth and performance. That's a good thing to show when you're seeking additional investment. Perhaps even more important, though, is applying ROIC to your reinvested profits. If you can generate a high ROIC through efficient operations and effective deployment of capital, you'll get the most growth per dollar invested. Add to that if the invested dollars are your company profits, and you've got a mechanism for compounding your growth with the least amount of outside capital. High ROIC on reinvested company profits will allow you to compound revenue and accelerate your growth like nothing else. Finally, we'll talk about the impact of company culture. Have you really nailed culture? According to Peter Drucker, culture eats strategy for lunch. Now, startup culture gets a ton of press these days. Most of it is wrong. We get the idea when we use the word culture that we're talking about food, art, entertainment, etc., the trappings of various human cultures. By trappings, I mean the thin surface elements of culture that we expect as tourists, sort of shallowly. But the hallmark feature of culture is not how it feels to go to work because of the foosball table or the monthly cubicle life budget. It's the deep essence of how work gets done in a company. More importantly, it's how work gets done when no one is watching. And that's where the power of culture is. It's in the ability for the employee to know what to do without checking in with their manager. This has an exponential effect in terms of the company's productivity and competitive advantage. One of the better pieces on culture is this video of a talk by Ben Horowitz about revolutions. You can see the full-length video at this URL. We'll just watch a portion of it here.
That was a very nice introduction. All right, how's everybody doing? Okay, we're going to get into it. Let's get into it. So I'm going to talk about culture and revolution today. And so I know a lot of you guys are saying, well, this is Startup Grind, and that's an interesting title for a talk. But why the hell are you talking about that, Ben? And let's start with culture. So culture is one of those things where when I was an entrepreneur, and I first started out, I asked everybody smart I knew who had run a company or was a venture capitalist or somebody, like what did I need to focus on from like a company building management perspective. And I got a wide variety of answers, and a lot of VCs would say, hire A players and that kind of thing, which was always great advice because I was going to hire a bunch of idiots, and that cleared it right up for me. But the advice that I got from the guys who really knew how to build companies was like, culture is really important. They would all say, culture, you got to focus on the culture, Ben. And I would be, okay, do you have anything beyond the platitude? Or is that just it, like culture? Could you explain to me what do you mean by culture even? And it was always very difficult for them to do that. And then as I became a venture capitalist and I work with companies and work with CEOs, this is the main thing that people don't even know where to begin. Okay, so first of all, what is culture? This is not culture. So dogs at work, yoga, organic food, that's not culture. It's perks. It's the difference between culture and perks. This is not about perks. This isn't culture either. Corporate above and beyond, independent, integrity. These could be aspects of culture, but you create corporate values and you put them on a wall, that's not going to get you a culture. And this is not a talk about corporate values and revolution. This is about culture. So what is culture? So this is a picture of me in the middle. You might recognize me. On the left to me is Admiral John Richardson, a friend of mine who runs the Navy. And when I say he runs the Navy, this isn't the Secretary of the Navy, the appointee. This is the CNO, the guy who spent 10 years underwater running nuclear subs, the guy who really runs the Navy, the guy who came up that way. And then the guy on my right is my friend Shaka Senghor, who spent 19 years in prison, and while in prison ran one of the largest, I'll call it prisoner organizations. And we got together, I thought I'd get them together to talk about culture because they were two of the best guys I knew with insights about running organizations. And if you think that was just my crazy idea, you can see the admirals holding Shaka's book. So they had a lot in common. And we talked about culture, and the reason I wanted to talk to them is they both had organizations where culture really mattered. Because if somebody comes into the Navy and they don't become part of the culture and they don't do things in the way you need to do them in the Navy, they die. And that's the same thing in prison. You come into prison, you don't do things the right way, you die. And it's not that funny if you're in prison. But anyway. On the other side, in talking to Shaka, Shaka says, one thing that really shaped the culture is the decisions that you make. I said, well, give me an example of that. He said, well, look, if a guy comes in and steals one of my guys' toothpaste, what I do there, that decision is going to matter a lot. And I'm like, well, if he steals a toothpaste, he's just very concerned with dental hygiene. Aren't you going to let him go on that? He wants clean teeth. Come on, man. He's like, no. He's like, you don't steal toothpaste in prison because you care about your teeth. That's a diagnostic. That's to determine if I can rape you, if I can kill you, if I can hurt you, or anybody associated with you. That's a diagnostic. So how I react, that determines the safety of all my guys. So the easy thing to do is kill the guy. Not the easy, but like that's an easy decision, right? Like you kill him, you protect your crew. But I make that decision to be that violent. My culture is that violent. Everybody making their own decision is just that violent. So this is how culture grows. And so when we talk about culture, these are the things we're talking about. We're talking about important decisions. We're talking about how you recruit, how you run the organization, decisions you make. And in a company, it ends up manifesting itself in a lot of different ways. But what it really comes down to is it is the collective behavior of your organization. This is who you are. You know, it's funny to read because CEOs go, well, that's not us. It's like, well, that's how you act. That's what you do. It's not us. It is you. It's your collective behavior. It's your culture that creates that environment. And it's what you do, it's what your people do when you're not giving them a direction, which is, guess what? Anybody who's run anything, 99% of the time, you're not telling people what to do. They're doing it on their own. They're making their own decisions. What do they do when you're not looking? Well, you do what your way of doing things is. And if you don't make that explicit, it will just create itself. It'll just grow that way. It'll just do those things. People want to harass each other, they'll harass each other. You know, people want to lie to customers, they'll lie to customers. Unless you said it, it'll just be what it is. So I know if you were like me and you're an entrepreneur, you're going, okay, great. This is great, Ben. You're telling us all about culture and how important it is. But guess what? Like I already missed half this stuff. I made a lot of decisions. I didn't even know that what I was getting into. So like, is it possible to change? And the good news is it is. And I'm going to take you through a historical example. So, and this brings me to Toussaint. In the entire history of humanity, there's been exactly one successful slave revolution. One. Now think about that. Slavery's been around a long time, basically all of written history. In 1600, I think, nearly half the world's population was enslaved. And yet there's never been a successful revolution, or there's only been one. So why? Plenty of motivation. Like, why didn't the slaves of the Han dynasty rise up and win? Why didn't the Gauls rise up and defeat the Romans? Why didn't the Christians rise up and take down the Ottoman Empire? Why did Nat Turner fail so fast? Like, what is it that stopped every revolution but one from winning? Culture. Turns out slave culture is absolutely detrimental to winning a revolution. What is it about slave culture? Well, one, when you're a slave, your life isn't worth much. You don't own anything. Your relationships are nothing. Your family can be taken away from you at any point. You can't invest in your future, and then you're not even generally allowed to learn to read or anything. So what does that mean? Well, you have then a culture that's got real challenges. You've got low trust. You've got no long-term planning. The population is generally ignorant and superstitious, and there's very low loyalty. And none of this is conducive to winning a war. So how did an ex-slave, a person who was a slave most of his life, well into his middle age, reprogram his culture, reprogram himself, reprogram an entire slave culture, and lead the only successful slave revolution ever? This was the worst slavery. This was some of the worst slave conditions in the history of humankind. So bad, I'll quantify it. U.S. slavery is known as a pretty brutal form of slavery. During the slave trade, 1 million slaves were brought to the U.S. At the end of slavery, there were 4 million slaves. People had babies, the population grew. In the Caribbean, 2 million slaves were brought during the course of slavery. At the end of slavery in the Caribbean, 700,000 slaves were left. That's how many people got killed. That's how bad it was. That's how brutal it was. So if you go to 1797, and at this point, Toussaint has already basically running Haiti. And this guy, Vincent de Vaublanc, was lobbying the French government, and because Toussaint's running Haiti, but still a French colony. And he's already freed the slaves. And this guy's like, look, I need to lobby the government because we can't let black people run this colony. Like, that's crazy. And he writes basically the most racist attack you could ever imagine. And he's like, these guys are ignorant and brutish Negroes. They're savages. You can't have savages running the island. They're going to destroy the economy. Like, it's going to be the end. Like, we're going to lose the colony. What are you doing, guys? And Toussaint's response was key because it's indicative of all the things that he did. He said, look, blacks are not lazy and ignorant savages. Slavery makes them so. He separated the color from the culture. The culture was driving the behavior. And then he goes on to show the Haitian Revolution has been less brutal and less savage than the French Revolution was. The economy is actually booming. He proved that it was a culture. So how did he change the culture? There are 4 keys to how he changed it, or 4 keys that I'm going to highlight. There were probably a lot more keys than that. So the first is he kept what worked. We'll get into that. The second is he created very shocking rules that caused people to change their behavior. The third was he incorporated people from other cultures and adopted their way of doing things. And then finally, his decisions demonstrated his priorities. So first, keeping what works. So when they started the revolution, Toussaint, everybody wanted to join. He was a very charismatic guy, very well-connected guy. He knew everybody. They all knew he was super smart. And so everybody wanted to join in. He said, look, I'm only going to take a small group at first because the tactic that I'm going to use, we can win with just a small group of people because we're going to introduce a communication technology that the opposition doesn't have. And that technology came from one of the strengths of slave culture, which was music. And so what Toussaint did was he set up, particularly the women on the outside, and had them sing certain songs that all his guys knew encoded with the exact maneuvers and attacks that he wanted them to do. So by doing that, he had long-range communication. He had more advanced technology based out of slave culture. The second thing he did is he created shocking rules. And shocking rules, like particularly when you get into a company, end up being the important thing because people have to question, they have to ask themselves, why does this rule even exist in order to change their behavior? And so the really crazy, shocking rule that he created was officers cannot cheat on their wives. And remember, like everybody is raping and pillaging in these days, like you win, you get to rape and pillage. That is a perk. That's like dogs at work. So how do you go from that to like, I'm not even allowed to cheat on my wife? Like that's like a big like back off of getting able to rape and pillage. And the reason he did that is because remember, one of the big problems with slavery is there's no loyalty because like you're in an environment where tomorrow doesn't matter. And so how do you build loyalty? Well, you say, look, you gave your word when you got married. If you're not keeping that word, how can we trust you to keep any word? You can't be part of this if you can't keep your word. And he famously said, I'd rather relinquish my command than break my word. Next thing he did was incorporate other cultures. And this was very unusual because you have to remember, he's running a slave army. And he decides, based on, and although he was a slave, Toussaint knew how to read, and not only did he know how to read, but he had read the complete works of Julius Caesar. And one of the things he got from Caesar was that as Caesar built the Roman Empire, he wouldn't kill the people he conquered. So when he'd go in and he'd conquer an area, he'd leave them in place. And the reason he left them in place is they were going to be part of the empire, and he needed somebody who knew that culture running that region. Toussaint also wanted to do something culturally, but he didn't want to preserve the culture. He wanted to change his culture. And so when he defeated the Spanish or defeated the British, what he did was he incorporated them and made those guys officers in his army. And that moved the culture much, much faster than it otherwise would have moved, because they had much more advanced cultures. They came from cultures who had a lot of the elements that he needed to build a winning army. And then finally, make decisions that demonstrate priorities. So what was the big decision he had? What are you going to do with the slave masters? That's a big thing, right? Like, what would your instinct be? Kill those guys, right? But what he did was he said, look, we need them for the economy because they're the ones who know how to run these plantations. So we're not only not going to kill them, we're going to say you can't have slaves, but you have to pay your labor, but we'll lower your taxes to make that possible. So he completely changed. He just removed the past and said, we're going forward together. This is going to be one country. So it's the only successful slave revolt in human history, creates a booming economy and a world-class culture. Under Toussaint, Haiti had more export income than the United States, so super successful as a country. And he defeated the Spanish, the French, and ultimately they defeated Napoleon, actually after Toussaint got captured. And his successor abandoned the cultural thing. Once they defeated Napoleon, he killed all the white people in Haiti, and the economy fell apart, and all those things that you would expect. So culture really mattered. Okay, great. That was a lot. How does it apply to me? What about me, Van? What is this? I thought that was startup grind. It's like Haiti grind. So keep what works. So some of you guys know Steve Jobs. Steve Jobs came back to Apple. When Steve Jobs came back to Apple, they were about 3 weeks away from bankruptcy. And the conventional wisdom across the board, everybody said this, every financial analyst, every industry analyst, the problem with Apple is they need to be more like Microsoft. You have to be more like Microsoft. You've got to separate Mac OS off of the Mac, and you've got to get clone makers to make, it, and you've got to go into the operating system market because PC economics has wiped it out. And that's what you have to do. And actually Jobs' predecessor, Gil Amelio, was doing just that. Jobs comes in and he says, what are you talking about? That's not who we are. Let me tell you what we're good at. We're good at building integrated stuff. And so not only am I going to kill all the clone manufacturers, but I'm going to make it more vertical. I'm going to build more hardware. I'm going to add a music player. I'm going to build stores. I'm going to go completely vertical because that's what we're good at design. We're good at the end-to-end experience. That's our culture. So you have to keep what's work. You want to change the culture, but you got to keep what's good about your culture. Second example, create shocking rules. So Mark Zuckerberg has this great rule. Move fast and break things. Now, it's like he could have said, we're innovative. We've got a company value of innovation. Put that on the wall, innovative. And you know what? Everybody would have looked at it and go, oh, yeah, we're innovative. But you go, move fast and break things. You're like, what? What? Break things? You want me to break things? I was an engineer. I fix things. Break things. Why do you have that rule? That's the key. If you get your employees asking themselves, why are we doing it this way? Then they're going to think about that answer when it comes. And the answer is, innovation is even more important than breaking things, getting into trouble. But move fast and break things creates that shock value that actually makes them an innovative culture. And if you look at them today, one of the things they do is they move fast. Incorporating outside leadership. Google they built Google Apps 5 years before Microsoft really got going with Office 365, and Microsoft ran right by them. Right by them. Why? Because there was no enterprise culture in Google. None. Nobody would do it. Steve Ballmer used to go to see CIOs, and he'd go, are you going to buy from me or from Google? Well, why don't you see if Larry Page will come visit you? And guess what? Larry Page never visited any of those guys because that wasn't their culture. Their culture was an enterprise. And the final thing, you have to make decisions that demonstrate priorities. So this is Reed Hastings, CEO of Netflix, and this was at our tech summit. And we're asking Reed, Mark, my partner Mark, is asking Reed, he's like, Reed, so you started out in the DVD delivery business, and then you went to streaming. How did you make that transition? How did you do it, culturally? How did that happen? And Reed said, it's interesting because we started out, the metaphor was it was a network. The DVD delivery thing was a network. It was high bandwidth, we could deliver a lot of big payload, but it was really high latency, 3 days. He said, and then we knew streaming was going to happen at some point, we just didn't know when. He said, but we really wanted to be a first-class streaming company, and we couldn't do that if we were totally focused on DVD delivery logistics. He said, well, how did you handle that? And basically, Reed said, well, it all happened one day. And on that day, and DVDs was 100% of our revenue. And we had a whole giant team running that business. And one day, I said, you guys aren't allowed to come to staff meeting anymore. He said it was a really hard day. They were really sad. Can you imagine that? The team running all of your revenue is no longer allowed in the executive staff meeting where you're talking about the future and the strategy of the company. That's an extreme decision. Why would you make that? Well, if you're really going to be number one in streaming and you're going to beat all of the people, every startup that's going into it, you've got to make it really clear to the company, that's the future. We're not messing around here. And he did just that. So look, I know that culture sounds abstract and I know it sounds hard, but I'm telling you, just like the old guys told me, it's really important. When you build a company, there's almost nothing that's more important than culture. And if this guy could overcome being a slave for 40 years and completely change a slave culture and defeat the French, the British, and the Spanish and free the slaves of Haiti 65 years before they were freed in the United States, then you can change your company and make it great. So thank you.
Here's Paul Graham again. He says, quote, inexperienced founders make this mistake when trying to convince investors. They try to convince with their pitch. Most would be better off if they let their startup do the work. If they started by understanding why their startup is worth investing in, then simply explained this well to investors. Close quote. What Paul G is talking about here is that VCs see lots of companies pitched. He says after a while, they all just run together. Investors who've been through this develop the ability to discern a story other than the one that you are telling. That story is made up of your personality and the key data points about your company. Your pitch, on the other hand, may have an agenda that investors want to see through. In order to keep things consistent, make sure your company's actual data is equally as persuasive as anything else you have to share. In the short term, valuations fluctuate. In the long term, though, valuations are inextricably tied to your company's fundamentals. Fundamentals include the qualitative, such as, do you know who it is that you serve? Are you creating ridiculous value for them? Do you have a culture of delivering insane value? And the quantitative, are you consistently growing revenue? Are you profitable? Are you growing your earnings per share? Are your unit economics solid? The closer you get to being public, the less speculative your valuation becomes. Public companies measure this via the PEG ratio. That is your price to earnings ratio divided by your growth rate in earnings per share. We talked about this in I think the first or second video. When this yields a number close to 1, you could say that your valuation is correct and that your stock is fairly valued. When your company is built on and consistently posts solid core fundamentals in clear and measurable ways, the fundraising dynamic shifts. As a founder, your confidence changes and your negotiating position gets much stronger. Your rationale behind your valuation is solid, and you know what terms match and when someone is trying to buy your stock at a discount. Remember that ultimately your company fundamentals will bear out. All right, that's it for this video. I'll see you on the next video.